When divorce enters the picture, business owners face a terrifying question. Will I lose what I have built? Today, we start a three-part series, and I want to speak directly to business owners. If divorce is on the horizon or already in motion and you own a company, or if you're married to a business owner, this episode is for you. This is not about theory. This is about what really happens behind closed doors when divorce puts your business on the table. I will walk you through the most common mistakes business owners make, the financial blind spots no one warns you about, and the strategies that can protect what you have built. Because this is not just about numbers, it is about your future, your legacy, and your ability to move forward without losing control of your business in the process. Today, I'm going to help you divorce-proof your business. Let's get into it. Marriage is about love. Divorce is about money. Without the right guidance, critical mistakes can have lasting financial consequences. That is where I come in. My name is Gabriela Martinelli, founder at Ever After Wealth. As a certified divorce financial analyst, I provide my clients financial clarity, strategic divorce planning, and long-term stability. On this podcast, I am sharing what you need to know about getting through a divorce, protecting your legacy, growing your wealth and assets post-divorce, and figuring it out what you really want in this next stage of life. Let's get started. So if you are a business if you're going through a divorce, probably you're feeling panic, overwhelmed, you're scared because this business that you built, what you have built through potentially 10, 15 years, or even longer, is at risk. And one of the biggest questions they face is, will I lose my business? Will I have to share my business with my soon-to-be ex-spouse? The reality is, like, business owners treat their businesses as a baby. And as much as my clients always walk to me and say, but it's my business, it's not her business. And I understand the concept, right? In writing, in paper, it is your business. Maybe you are the only one running this business because it's a business that you own on your own. Sometimes I have clients that own a business with their spouse, which creates another layer of complications, right? Sometimes I have business owners that own a business with a third party, which is a partner. So going through this process generates all kinds of changes that are not happening just at home, they're happening on the business. Cash flow can be affected. The work that you put in the business can be affected. Your personal emotions are going to affect the business. And on top of that, because as business owners, we're always trying to pull out fires and trying to anticipate. Usually you feel like you had to do some damage control and you're trying to control everything, right? From the financial point of view, the legal point of view, the emotional point of view. And this is going to affect your business one way or another. What is very important for my business owners to understand is that just because your spouse did not work in the business doesn't mean that this business will not be part of this marital state that you're going to be dividing. And I think that's one of the hardest parts for my business owners to understand. This is your baby. You grew the business. You learn as you were growing. You have maybe employees now, and now they're all depending on this situation that nobody really knows where it's going to end, right? Because as much as you want to control this, you won't be able to do that. So it's very important that you have a strategy and not act out of the panic of what can happen now, or taking the position of this is my business and they don't have any right to it, because it really going to make things a little bit more complex, if you will, as this process continues to go through. So when it comes to a business, I always use the comparable with my clients is the marital home, right? We always talk about the marital home is one of the biggest assets, is one of the assets that is more attached to emotions. The kids grew up in the house. So that is a very complex asset, if you will, to decide who's going to keep the house, if anyone. But when it comes to the business, we have an extra layer because as a business owner, usually your identity is connected to this business. This is your livelihood. This is your income, but also more likely is your dream. This is something that you created, probably most cases, not all of the cases, but you created this out of nowhere. So this is literally your dream, your creation. You founded this business, you put your tears and your work into this business to make it what it is today. So when we start having these conversations and there is the thought of, oh, wow, someone else will have some rights to this business and it's not maybe your business partner, it creates a lot of anguish in the fear and the pain of having to let go potentially of something like that. In reality, that's not usually what happens, right? If you run in a business that you run by yourself, your spouse will be entitled to partial of the value of this business, right? But they're not going to literally go and get the business. But I do understand from a psychological and emotional point of view, this happens. So the biggest problem that I see here is when you get attached so much to this business and you get almost defensive during this process. First of all, it creates more distrust with your soon to be spouse, attorneys, or any other business professional that you work with. Because, for example, you're going to have to get a business valuation. This means you're going to have to open up your books. You're going to have to share all the information about your business with third parties, and they're going to come and put a number, a value on your business. And we will have another episode. We're going to talk specifically about the business valuation, but I wanted to touch a little bit because I understand how difficult it is for someone that you don't know and is a third party and probably doesn't understand how your business works to come and say, this is what your business value is. And it's very hard to do. And if when we start this process, you feel the possessive side of the business to come out, it does generate more conflict. It's going to get you to a point that it generates more distrust with the other side. And it is a disadvantage coming to the table when we're trying to find a settlement or a negotiation. From the point of view of the business owner, I understand the emotions. My role comes to help you understand that we need to tune down those emotions and we need to really think of the business for this tiny period of time when we're talking divorce settlement as a separate entity that is part of these assets and part of the marital estate. Like we think of a car, or you think of a house, or you think of a bank account almost, if you will. Another item that you have to consider is if you have employees or even if you have a partner, right? When you're going through divorce, you personally are going to go through a different emotions and overwhelm and the uncertainty and not sure what's going to happen. Well, that is going to affect everyone in your business as well. It's going to be your employees or it's going to be your partners. Your partners are going to have to open their books as well, right? So they will be dragged into this situation, even though they're not really divorcing anyone and it's just you. However, it's going to affect them. What happens is that it's like a snowball process, right? Your employees start seeing that you're not working as many hours or you are in a different type of emotional state. Your partners see that you're not paying attention. They don't know. Now they know there's a divorce happening and nobody really understands what that means for anyone, right? Because you don't understand and you are the business owner. Those individuals understand even less than you do. So that affects your business. Anything that happens from the moment that you decide to go through the separation or the moment you find yourself in this situation, up to whatever we can find a settlement or a decision from the court in this case, what's going to happen with the business? Everything you do personally is going to affect the business. It will affect your income. It will affect the value of the business potentially. And it's something that you had to be very careful when you are approaching this, because there's also the fact that we don't want to show or maybe give the inclination that we're doing something to diminish the value of the business because of the settlement that is coming because of the divorce. So there's a lot of strategy that goes with this, but I want you to know that as a business owner, and because 75% of my clients are business owners, I understand the emotions and the emotions you're going through. So my role is to help you hold on to those emotions, try to take away from your plate having to deal with the logistics of doing the business valuation, understanding your numbers, how the business works, so you can at least continue to protect that asset and something that you created that we want to protect it. but you cannot go through the process without having that support, because it will affect the biggest asset that you have in this situation, which is your business. So taking into consideration what I just talked about, the emotions and the attachment you have to your business, today I want to talk about how we can make sure that your business is divorce proof. And I want to be very clear. This is not me promoting divorce. This is me promoting security and protection. If you're not going through a divorce, but you think that you may be going through this process, or you're just simply curious, I can help you identify the little items in your business today that will affect you negatively if you decide to go through a process of a divorce. Now, if you just started this process, this is probably very helpful. If you're going through this process for some time now, it's okay. It's not too late. But these are things that are basic information that you should have as a business owner as you move forward during this process, because it's the very basics. And they may seem they're not as important, but they will affect the case. They're going to affect the outcome, a potential settlement, and this is going to affect your valuation of your business, which is basically how it's going to be decided how the marital estate is going to be divided and how you may potentially have to pay your spouse because of the business and the value of the business. So this helps you stay prepared, or be prepared before, or let's get prepared now if that's what you're going through right this moment. So the first item on the list is keeping your books clean. Most of my clients, they're business owners, they're very successful running businesses, but they make one of the biggest mistakes a business owner can make, and it is paying for personal or family expenses through the business. And I know there's someone there is listening and they're thinking, oh my God, it's me. Yes, because it's one of the biggest mistakes that business owners make. So sometimes I'm working with my clients and I start looking at their books, right? Look at the P&Ls, look at the expenses from the business. Do I see? I see a lot of dinners. I see a lot of grocery shopping. I see nails salons. I see vacations, a lot of trips. I see mortgages being paid, and mortgages that are not for a building or real estate owned by the business. No, this is their marital home, the home where the family resides. I see utilities that not all of them are because of the business. So when I see that, it immediately is a red flag, because in reality, you should not be running your personal expenses through your business, right? So that's just a no-no. However, when you're going through a divorce, that creates a whole other level of complexity, because there's a couple of things that are going to happen here. First of all, someone that is not going to be you, and it may not be me doing the valuation of your business, is going to have to go into your books and decide, this is a personal expense, this is a family expense, this is a business expense. And the problem with that is that they don't know you, they don't know your business, they don't have time to get to know anything, and they're going to get it wrong. They're going to be taking different expenses here and there, and they're going to decide themselves, this is not a business expense, and they're going to remove it from your business valuation, right? And that creates all kinds of issues, because maybe that dinner party was for all of your employees because you guys were celebrating your anniversary, and they decided that that was a family expense and it's taken away, which it changes the value, right? Maybe there's a trip that it was a conference that was because of the business, but they decided that was your vacation, because they are not going to have a conversation with you for you to identify. And honestly, I don't think you will remember. So when you have messy books, everything is mixed up. It's not just that it's going to cost you more money because someone has to come and clean up those books. Someone is going to potentially get it wrong if they do that. And it also creates a lot of distrust, because I know, because a lot of the times I hear my clients say, but she knows we pay everything from the business. Yes, she knew that you were paying everything from the business when you guys were together and you were partners and you were in a family, but now she's not. And I promise you, she's not going to remember, and she's not going to admit to that either. Her attorney is not going to let her do that, right? And her professionals are going to try to disqualify that assessment. So you're coming to the table with messy books is going to affect the credibility, right? Because even if you're not hiding anything, which the majority of my clients are not hiding anything. But the problem is that we need to show that we're not hiding anything. So it has to be up in the table and very clear for everyone to understand family expenses, personal expenses. So your books have to be clean. So either if you're going through this process, just started, let's go take a look at those numbers and make sure that everything is separated because it's going to help us understand the true family expenses, which, by the way, are going to have a lot of consequences when it comes to support payments, right? And your business expenses, which are going to have something to do with your business valuation, which is the value your business is going to be used for your business when we go through the division stage and the settlement stage. So, number 2, your income. Things get a little complicated when we own a business, right? It's really hard to identify what's truly your income, what's the business income, and how much of that business income is accessible to you. That is going to be one of the biggest conversations you're going to have. And it's very important that we understand how this works. So there's one item. If you're a W-2 employee within your business, that is perfect. That's income. That separates you on the personal level. And it's going to be like, okay, that's your income. However, if you're also taking distributions from your business, that is going to affect your income. And one of the biggest challenges for my clients is to understand that sometimes there is double dipping because you're using income that is going to be used in your business valuation. And then maybe that income is also going to be used as your personal income when it comes to your payment of support, potentially, if that is what the case requires. So we had to be very careful about that because you cannot make drastic changes during this process, right? Like if for the last 10 years, you're giving yourself a W-2 and you're also paying yourself $50,000 in distributions, for example, you cannot suddenly say, I'm not getting these distributions anymore. Because it's something that individuals tend to do when they're going through a divorce. And that is a red flag. And they're going to be like, why? You can argue with me and say, yes, I'm not making enough money. The business is not making the same amount of money. I can see that and I can even agree with you to a certain level, but we need to be very careful. This goes back to the books, right? If everything is very clear, we're going to be able to provide the information where it's very clear for everyone and everyone will believe what we're showing them without distrust. So understanding your income is very important. So if your income is working one way, don't make sudden changes to that while you're going through this process because it's going to put a red flag. And again, that distrust is going to come in. And when that happens, most of the time you can't really find a settlement. And you have to think ahead one more time. If we're going to have to end up going to court, we're going to have to convince the judge that what you're saying is true. And we need to make sure that the numbers are showing the story that you're telling. So if we make a lot of changes, you can't really get there. The other part of this is you're going to have tax liability individually and you have the tax liability with your business. All of this is going to tie it up when it comes to doing the business valuation because they're going to look into, well, your income is actually an expense to your business. So it's going to reduce the earnings of your business in a sense, right? And you will get some kind of credits because of your income. Then you have the actual distributions. Well, the distributions can also look like a credit somewhat in your business income. However, you're going to have to pay taxes and you're going to pay different level of taxes. You're going to be in a different bracket because that is going to be distributions from a business and it's not your W-2 and more likely there's not going to be withholdings for your taxes. So that's the number 2. We need to identify and be very clear what your income is, which by the way, this is also tied to your expenses. If you're paying personal expenses through the business, they literally should be qualified. They should be categorized as distributions. So that right there is increasing your income because you had to put your personal expenses as distributions when you do your books, if you do it the right way, basically. And again, we'll go back to the issue, who's going to identify that? Who's going to make sure that that is correct? So that's the income. Third, you're going to have to get a business valuation. This is very important because this cannot be guesswork. You cannot just say, oh, I think my business is $2 million or $3 million. No, there's some aspects of this. You need someone that can evaluate your business. First of all, I always recommend someone that understands your industry. a lot of my clients are physicians. So I usually go to business evaluators that understand how medical practices work. Every business works differently. So you will have to really talk to this professionals. I usually do that for my clients to know that they understand your business, but they also understand divorce. When you do a business valuation for a divorce, it's done with different parameters than what is done for, you say, if you want to sell the business, or you want to see if your business is marketable, or maybe you want to talk to a lender and get some money out of your business because you want to start a new part of your business and you can get something new. It's very different the way that a business is valued when you're going through a divorce, because they take a little bit into consideration the future, but in a different way, right? Because you get into the muddy water of, okay, what is divisible, what isn't divisible, what is marital, what's not marital. So someone that understands how the divorce process works when you're evaluating a business is very important. In this case, it cannot be just a broker that says, oh, I can do this and I can sell your business for X amount of money. That is not acceptable. You need to have the right professional guiding you with that. And a lot of the times what I do, and we'll talk more about when we talk business valuations, but I help my clients understand the valuation and a lot of the times find little holes in the valuation, especially on the other side, because a lot of the times these professionals don't understand how this should work for divorce. So it's very important that we not just get the right professional, but also identify the blind spots that the other side's professionals didn't identify in their valuation, which may be to your disadvantage, honestly. Okay, so those are my 3 main items that you should consider if you're a business owner and if you're going through a divorce or you think that you may go through a divorce in the near future. There's a lot more that I could share with you, and I will share in the future episodes that are dedicated just to business owners. So stay tuned and see you next time. Thank you so much for listening to the podcast. If you're going through a separation or divorce, please contact me through my website at everafterwealth.com. I would love to be a resource and partner as you navigate this season and prepare for your financial future. I'll see you in the next episode.